Hello and welcome to our Financial Review 2023. The Hong Kong economy got off to a strong start, with the government rolling back COVID-19 pandemic restrictions, and inbound tourism and private consumption underpinned economic growth. But global inflation and rising interest rates would dampen the year.
The year began with cautious optimism, as the government signaled a lowering of COVID-19 pandemic restrictions.
For us, what we really expect is to see the normality coming back to Hong Kong. And for that to be possible, we need to remove the remaining complexities that make people believe that it's difficult to come to Hong Kong. Do you risk to test positive and then be placed in quarantine?
Quarantine-free travel between Hong Kong and the mainland was restored by mid-January. Mainland enterprises came to the first trade fair since the lifting of quarantine restrictions. Due to the pandemic, this company had not participated in toy shows in Hong Kong for 3 years. It showcased products manufactured over the past few years, hoping to retain old clients and attract new ones.
We have many new products and many different types of toys to show at the fair. In the past, we only had one major item in one show, but this time we have 5 new products.
The trade show organizer encouraged international buyers to attend the fair in person.
Over the 4 days of our 3 international trade shows, we had attracted 1,000 exhibitors and over 21,000 buyers attending the shows physically and virtually. I believe Hong Kong is returning to normal, and the industry we're optimistic about the future of the business sentiment.
Almost all border and COVID-19 pandemic restrictions were removed by March, including the mandatory mask mandate.
It's amazing. Hong Kong is finally back. No masks. You can really see people.
The lowering of border restrictions enabled overseas visitors to return.
If we think about this time last year, the border restrictions had only just come off and people were starting to come in. So this is the first real year that more and more people coming in, whether they be coming over the border using high-speed trains or whether they be coming in through the airport.
Visitor arrivals grew to more than 26 million in the first 10 months of 2023. But that's more than 50% less than the 56 million visitor arrivals in 2019. The hotel occupancy rate was in the 80% range for much of the year.
Obviously, you had the Hello Hong Kong scheme, which was launched at the beginning of the year to kind of kick that off and to bring more people in. And also, the tourism board is working hard to get new events, new exhibitions, new conferences to come and base themselves in Hong Kong.
Live performances and global events finally returned. Simon Bratt was thrilled to bring the music festival Clockenflap back after 4 years of not hosting it because of the protests and the pandemic.
We felt there was enough confidence that we could run an event with the sort of experience that we wanted, which is attendees being able to move around the site freely, enjoy music at different stages, be able to have F&B.
And the trade exhibitions and conventions benefited with the return of overseas visitors. Nearly 1 million visitors attended the book fair this year, more than in 2019. Art Basel held its largest edition since the pandemic. New shows opened. Cosmoprof Asia, a large beauty trade show, returned to the city after 3 years.
First, we are in Greater China. Access to mainland China is the world's second largest market for beauty. Cannot ignore that. Everybody wants to be there. And the accessibility through Hong Kong is absolutely perfect.
The city hosted nearly 40 fairs and trade shows by August, and was on track to reach the pre-pandemic levels by the end of the year. Despite the positive news, it would take some time for the industry to recoup their losses from the pandemic years.
We've had 3 years with no exhibitions at all, or very, very few. You'll see that organisers, venues, contractors have been losing a great deal of money over the last 3 years. So, it's going to take some time to restart. It's going to take some time to get back to the scale in which we were before.
This bar owner was happy to have live performances and a packed house again. She was able to host events 7 nights a week, but it would take some time to become profitable.
There have been individuals who lent money as well, large sums of money, to help us survive. And much of what's going into this period of time is paying back some of those loans and starting to pay down the debts that accrued during the pandemic time.
In February, Financial Secretary Paul Chan announced another round of consumption vouchers of $5,000 per person to provide support for people impacted by the pandemic.
You understand that intention of launching consumption vouchers was to do something to help with the poor economic performance. We see signs of economic revival. It's quite obvious in the F&B industry, but not so in the retail sector. And that is even worse for those in the export sector.
Once pandemic restrictions were lifted, Miss Zheng went back to dining out. On this day, she took her mother to a restaurant and used their consumption vouchers.
Before receiving the consumption voucher, I had less dishes. After I received the voucher, I have 2 more dishes. I am happier. I will take my mom to restaurants more often.
This pharmacy owner said his customers spent more money on medicine and supplements after they received their consumption vouchers.
The family members will gather their vouchers together to purchase medicine that they can use over the next few months. So, our business volume jumped sharply. They do purchase more with vouchers. In the past, the average spending is $200. Now they spend $600 to $800. The increase is several folds.
Retail sales grew 17.2% in the first 10 months of the year compared with a year earlier. The unemployment rate dropped to a 4-year low over the summer to 2.8%, meaning just about everybody who wanted a job had one. At a job fair, this doctorate student was checking to see what opportunities were available.
If some company has some job position is related to the policy analysis, I think is which I prefer. Maybe the industries, business industry, art industry is also okay for me.
Organizations in Hong Kong had a difficult time hiring employees.
For Hong Kong to grow, first of all, we need more people to work here in Hong Kong, and there are a demand for talents at different levels of different skills. So apart from growing our own local talent, we also need to attract from overseas, from the mainland, so that we have a much bigger pool of talent to help Hong Kong.
In late 2022, the government launched the Top Talent Pass scheme, which allows graduates from top universities to relocate to the city to look for jobs. By late October this year, the government received over 180,000 applications and approved nearly 120,000.
A majority are coming from the mainland, but also a sizable people, they're educated overseas with a very, very good education background, having their degree either in America or in Europe.
The government also launched a new pilot scheme for non-local students to get a higher diploma in Hong Kong and then find a technical job in the city. The secretary believed the new schemes were successful in easing the labor shortage. This technology consulting firm struggled to hire people in April.
So we had recruited someone out of the local university. They worked about 2 months as an intern. When they finished the internship, we offered them a full-time position. We offered them $17,000 per month. They said that that was too low. And that person still rejected that position at $25,000 and was looking for $30,000 coming directly out of schools.
By the end of the year, the starting salaries for the job openings were about $17,500 a month. And Jeffrey was pleased to meet a lot of job seekers at this fair.
We've had people lined up 3-4 deep at our booth waiting to speak to people. So from a business standpoint, it's been very good for us. And there's a huge selection of talent available for us to select from.
Between mid-2022 and mid-2023, the city recorded a net inflow of 174,000 residents. Some people arrived through the talent schemes, and residents who stayed abroad during the pandemic returned to the SAR. This conference organizer recently returned.
Right now, I'm committed to seeing what's going to happen here for the next few years. That's my job, and that's a lot of businesses out there.
I am looking forward to a more dynamic Hong Kong. I think the city is waking up. I think it would help me in particular with my business, with real estate. I think with people coming back, Hong Kong will bounce right back. And I honestly think it's going to be one of the best cities in Asia again.
When we return, find out how external factors affected the city's stock and property markets. Stay with us.
Welcome back to our Financial Review 2023. Global inflation, rising interest rates, and a slower than expected economic recovery in China made it a tough year for everyone. By the last quarter, the Hong Kong government reduced stamp duties to stimulate the property and stock markets.
At the beginning of the year, there were high hopes that the export sector would recover. Hong Kong is a re-export hub for Chinese-made goods, and electronics make up 70% of the city's exports.
Because of the reopening of the border between Hong Kong and Shenzhen, so that's why we are getting back to normal for the cargo flow. So that's why most of our electronic products which are produced in the PRD area or the GBA area, they are now having no difficulties to export via Hong Kong.
But with the decrease in global demand for products from China this year, the city's exports dropped by 11% in the first 10 months compared to a year earlier.
We may not be able to go back to the level of last year or the year before because that's a COVID period. All the countries are locked down, all the countries are not producing, except China was still producing. So these 2 years are abnormal years where the exports are abnormally high.
Rising costs around the world squeeze the profit margins of Hong Kong businesses.
Globally, we're looking at the supply chain problems right now, and we see, in all different countries, there is a shortage of labor or, different variables that are affecting, costs of raw materials. So right now, the whole industry is, facing increasing costs of, different types of raw materials affecting, basically your costs on your daily menu.
Inflation rose more than 2% in the first 11 months year on year. To clamp down on inflation in the U.S., the Federal Reserve raised the Fed funds rate 4 times by July this year. The Hong Kong Monetary Authority followed the Fed's lead and raised its base rate to 5.75%. This raised the city's cost of money to the highest level in 16 years. Prime rates in the city were raised to 5.875% or 6.125%, depending on the commercial bank. The property market was affected by high borrowing costs.
The current sluggish of the market, I think, stems from uncertainty on the interest rate hikes, because higher interest rate will mean, more monthly mortgage repayment and also means lower affordability.
And Ryan said the weak mainland economy also affected the property market.
We expect after the border open, a lot of the mainland buyers will rush to Hong Kong and buy up our properties. Well, that did not happen. Well, obviously because the economy in the mainland was not doing good as well. Probably, the sentiments for mainland buyers are not very eager as well.
Prices of lived-in homes fell by nearly 4% this year, according to the Centa City Leading Index. Government figures show residential property prices dropped 20% since a peak in 2021. Chief Executive John Lee announced in his policy address that the government would slash extra stamp duties, the first time in over 10 years. A variety of stamp duties known as spicy measures were introduced in 2010 to curb soaring property prices in a low interest rate environment. One measure, the special stamp duty, or SSD, amounts to 10% of a home's price. It was imposed on transactions involving property held for less than 3 years. The CE shortened the SSD period to 2 years. Surveyor and homeowner Kit Jung bought this flat 18 months ago. In 6 months, he can sell this flat without having to pay the 10% special stamp duty.
The housing price is still under compression, and it still have a risk of further moving down. In case I sell this house now or 6 months later, the housing price will be lower than the original price I purchased it 18 months ago. So I will still suffer a loss.
Another measure required a homeowner to pay 15% new residential stamp duty, or the ad valorem duty up front. The chief executive lowered the stamp duty to 7.5%. But Kit said he wouldn't consider buying a second home for investment because of the high interest rates.
Each month, when you are leasing out the property, you can only collect around 3% of rents from the market, but at the same time, you need to pay out around 4% of the interest cost to the bank. So you are actually suffering a net loss.
The easing measures did not immediately help boost property prices.
Obviously, there's an increase in the property transaction, but the price is still not reacting to this release of the measures, because the measures, on one hand, of course, it lower the cost for people to buy the property, but on the other hand, it also allow people to exit the market more easily.
The chairman of JLL says the cutting back of the spicy measures may be too little too late.
Sentiment is really bad. I think the market will have roughly around 4 to 5% corrections. And next year, probably another 10%.
Rental prices rose more than 8% in the first 11 months of the year, according to the Centicity Rental Index.
This is 2,038 square feet.
Ronnie Lakhani managed the leasing department for a real estate company.
The new set of people coming in to Hong Kong are a very mixed bag at the moment. You've got people coming back from America, the mainland Chinese, the American Chinese coming in. People are looking for a better property today. They are willing to pay the price.
The Hang Seng Index was headed for a 4th year of declines, the longest losing streak in the gauge's history. The HSI tumbled more than 4,000 points as of mid-December, or some 20% since the beginning of the year.
The composition of Hang Seng Index, the constituent company, a lot of them are from China. So, but some of these companies are not doing well, especially the real estate sector. So they actually make the Hang Seng Index to go lower.
Investor sentiment was hurt by the high interest rate environment and a slower than expected economic recovery in China. Foreign investors reduced exposure to China amid sluggish economic data and persistent crisis in the property sector. Daily turnover on the HSI fell below $80 billion on numerous occasions since the second quarter, half of the average daily turnover of $160 billion in 2021. To boost the competitiveness of the stock market, Chief Executive John Lee announced in the policy address that stamp duty on stock trading paid by both buyers and sellers would be cut from 0.13% to 0.1%. It meant investors would save $3 per $10,000 in stock transactions. The amount of new funds raised by initial public offerings in Hong Kong this year hit a near 2-decade low. By mid-November, there were only 61 new stocks making a debut on the bourse, marking a nearly 20% drop year-on-year, according to Ernst & Young. These new stocks raised over $41 billion, a plunge of almost 60%. In early December, Moody's cut the SAR's credit outlook to negative, a day after downgrading China's credit rating. Moody's said the mainland's weakening economy would affect Hong Kong's finance-dominated economy because of the region's close ties. Financial Secretary Paul Chan said the city would record a deficit of over $100 billion this financial year. because of shrinking revenue from stamp duties and land sales. By November, the government lowered the full-year growth forecast from between 4 to 5% to 3.2%.
It is a little slower than what we have originally hoped for, mainly because of the export situation is not recovering as good as we have expected, given the current geopolitical situation and the comparatively depressed asset market. Short term, still challenging.
The mainland economy showed signs of improvement near the end of the year. By November, the International Monetary Fund said China was set to grow 5.4% this year. The upward revision from an earlier 5% forecast reflected a stronger than expected growth in the third quarter and new policy support. The government approved a 1 trillion yuan sovereign bond issue,
which will meet the target of the Chinese government economic growth target. And the recent unemployment rate for urban area has dropped to 5%. The trade in November also increased, the export also increased. The export of like electric automobile also increased.
But the property market remained sluggish. From January to November, investments in real estate development plunged 9.5%, according to the National Bureau of Statistics. That underscored weak confidence in demand and investment, as scores of large developers face serious debt problems.
There are like occasions where the developer default, and that actually affect people confidence in buying the houses, and that actually accelerate the crisis.
Ready, close.
Sino-U.S. relations appeared to improve as President Xi Jinping met with the U.S. President Joe Biden on the sidelines of the APEC conference in November. While some simmering differences remain, the 4-hour meeting saw warm exchanges between the two leaders, with agreements ironed out to step up dialogues encompassing military and AI-related matters.
We have to ensure that competition does not veer into conflict, and we also have to manage it responsibly, that competition. That's what the United States wants and what we intend to do.
Back in the SAR, the future may be looking a bit brighter in the new year.
We are also looking at the mainland's economic recovery. It seems they are heading towards better direction. If that is the case, I think it would be a stronger recovery for us.
That's the show. Thanks for watching. Pearl Magazine returns next year with a look at what's in store for 2024. Bye for now.